As the U.S. markets are closed for the weekend, I can provide the final closing data from the last session. On Friday, November 7, 2025, ACHR Aviation, ticker ACHR, finished the session at a price of $8.17. This was after a brutal day of trading, where the stock plummeted 7.94%, a loss of over 70 cents per share. What makes this move so significant wasn't just the drop, but the sheer volume. An incredible 153.8 million shares changed hands, which is nearly triple its average daily volume. The stock was under assault, trading in a wide range from a low of $7.20 all the way up to $8.21 before settling at that closing print. Now here is the absolute disconnect. The stock just got annihilated. And what was the terrible news that supposedly caused this? They announced on their Q3 earnings call that they had just raised an additional $650 million in equity, bringing their total liquidity, their cash on hand, to over $2 billion. And as if that wasn't enough, they also announced they're acquiring Hawthorne Airport in Los Angeles for $126 million. Let that sink in. The company now has a $2 billion fortress of a balance sheet and just bought an entire airport in a key strategic market, and the stock response was to crater by 8% on massive volume. This is one of the most perfect, stark examples of expectation versus reality that we have seen in this sector all year. The market, it seems, is completely missing the point. The common narrative, the one you hear from people getting their investment help from social media or just glancing at the Robinhood app, is that ACHR is a dream stock. It's the flying car, the futuristic transport, the next Tesla stock. The expectation is that you buy a few shares in your individual brokerage account, maybe on the SoFi Invest platform, you hold it for a decade, and you wake up wealthy. It's a simple, clean story of a shiny new technology. But the reality, as this past week's price action demonstrates, is that ACHR Aviation is not a simple story. It is not, at this moment, a transport company. It is a pre-revenue, capital-incinerating, advanced manufacturing and logistics company. It is in a brutal, expensive business. And that $2 billion in liquidity? It's fantastic news for the company's long-term survival, but it came at the price of that $650 million equity raise. For existing shareholders, that word, equity, means one thing: dilution. The market choked on that dilution. It saw the $650 million raise and panicked, focusing entirely on the short-term pain of its stake being watered down. The price action on Friday was a textbook short-term reaction. The market is completely, and perhaps foolishly, ignoring the fact that buying Hawthorne Airport isn't just a line item. It is a profound, long-term strategic chess move that positions them as a dominant force in Southern California, a key hub for the 2028 Olympics, and gives them a test bed for their AI-powered air traffic systems. The market is playing checkers, while the company is playing chess. Let's look at the numbers from the Q3 report because they tell the real story. The company posted a net loss of $130 million. Now that's better than the $206 million loss in the second quarter, so they are managing costs, but their cash used in operations was still $126 million for the quarter. This is the clock they are racing against. That $2 billion war chest is everything. It buys them time. It buys them the runway to get through the single most important hurdle in the company's existence: FAA type certification. This is not a stock like Apple stock or Nvidia stock, which are proven, profitable giants. This is a binary bet on certification and commercialization. And it's a bet that big, serious players are making. While the stock's daily chart looks terrifying and many retail investors using Robinhood stock trading or the Fidelity mobile app were likely hitting the sell button, the institutional ownership data tells a different story. Recent SEC filings from the third quarter show that the giants, the ones who use sophisticated tools like the Interactive Brokers platform, are buying what retail is selling. Vanguard filed that it increased its position by over 16 million shares. BlackRock added over 11 million shares. D.E. Shaw, a massive and highly respected fund, reported adding a staggering 16.6 million shares. These institutions, using Fidelity, Schwab Intelligent Portfolios, or their own in-house Fidelity Wealth Management style desks, are not making emotional trades. They see this weakness as an opportunity. They are accumulating. They understand that a $2 billion balance sheet and a wholly owned airport in Los Angeles are far more important than a single day's dilution. This is the deep, underlying tension. The smart investment money is flowing in while the price is temporarily falling. So what does ACHR actually do, and what are the real hurdles? The company is building the Midnight, a piloted 4-passenger electric vertical takeoff and landing aircraft. The goal is to create an air taxi that turns 60 to 90-minute car commutes into 10 to 20-minute flights. The business model is twofold. They have to build and certify a revolutionary aircraft, the product, and they have to build and certify an entire airline from scratch, the service. On the airline side, they're actually making huge progress. They already have their Part 135 and Part 145 certificates from the FAA, and they just received their Part 141 certificate to run their own pilot training academy back in February. That's 3 of the 4 key operational certificates needed. But the big one, the one that matters more than anything, is type certification for the Midnight aircraft itself. And here is the other dose of reality. The company has been optimistic, but a Bloomberg report from mid-October suggested that full certification is unlikely before the end of 2025, and that passenger flights are likely postponed to 2026. This reset of expectations is also partially responsible for the recent stock pressure. The when is just as important as the what. So what's the path forward? This is where online investing gets incredibly difficult. This is the ultimate self-investing dilemma. This stock is not a safe Fidelity mutual fund or one of the many Fidelity ETFs that track the S&P 500. It is not a set-it-and-forget-it holding for your Fidelity IRAs. This is an active, high-stakes speculation. You can use any of the investing sites you want, a SoFi trading platform, an Interactive Brokers account, or your Fidelity brokerage. The tool doesn't matter. What matters is your conviction and your time horizon. The bull case is now clearer than ever. The company is funded to the teeth. It has over $2 billion in cash, which should be more than enough to get it through certification and into commercial production. It has a fortress in Los Angeles with the Hawthorne purchase. It has a massive order book from United Airlines. It has a clear technological lead, with its Midnight aircraft recently completing a 55-mile flight at 10,000 feet. The bulls believe that in 3 years, this $8.17.5 price will look like an absolute steal. The bear case is just as clear. The cash burn is real, $126 million per quarter. That $2 billion can disappear fast if there are more delays. Competitors like Joby and others are intense, and the macro environment of high interest rates is brutal for pre-revenue companies. Then there's the insider activity. Filings from the last few months showed the chief legal officer, the chief technology officer, and the chief financial officer all selling shares. Now, these are often pre-planned 10b5-1 sales, but the optics are terrible. It never looks good when the people running the company are selling, even as big institutions are buying. Comment below with what you think was the real reason for the 8% drop on Friday. Was it the logical, if painful, reaction to the $650 million dilution, or was it the market getting spooked by insiders selling shares right before the earnings report? I want to know what you think. When you look at SoFi stocks or Robinhood investments, you see tickers, but with ACHR, you have to see the full picture. This isn't a stock for Robinhood fractional shares. It's a stock for a fully allocated, high-risk portion of an intelligent portfolio. The platforms offering SoFi active investing or interactive brokers trading are just venues for a war between two ideas: the dream of a new transport system and the crushing reality of the cost to build it. So, ACHR Aviation ends the week beaten down, closing at $8.17. The market's expectation was for a simple, clean, positive earnings report. The reality was a complex, messy, but incredibly strategic set of announcements that solidified the company's future while simultaneously diluting its current shareholders. The market sees the dilution and the insider selling. The long-term bull sees a $2 billion war chest and a strategic airport in Los Angeles. The expectation of a smooth, futuristic story just collided head-on with the gritty, expensive, and dilutive reality of building a business from nothing. What you decide to believe about that collision will determine how you see this stock. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment